What's going on, everybody? I hope y'all have had a good week. We're headed into the weekend. Hope you have a good weekend as well. But I wanted to put out a video that really covers why I'm bullish. If you've been looking at my X account or been seeing some of the stuff I've been ranting about in the group chats, you know that I'm bullish going into the end of the year. I think one of the big disconnects between the people who are bullish right now and who are bearish is a lot of people use more information than just a chart. Okay, a lot of people will look at this chart and zoom out on it like this, okay, and say, oh, well, it's gone up a lot, so the risk reward isn't very good. Well, number one, even if you were to take that logic, which sometimes is true, but if you were to take that logic, number one, it doesn't even look bad on any time frame at this point. So on the monthly time frame, just looks like it's consolidating. If I go to the weekly chart, just looks like it's consolidating between a range, much like it did here and much like it did here. 2023, 2024. There's no secret for why this happens. The reason why this happens is because Bitcoin is not like the S&P 500. It is not like Nvidia. It is not like stocks generally. This is a commodity, number one, a digital commodity, and it doesn't have aggressive flows in it all the time. Flows come in short windows when people are not positioned correctly for them usually. We can see here that you had this big consolidation for about 6 months, and then it was kind of up only. People waited for a big pullback. They never got one. We can see here, and this was actually this was the biggest move of the cycle so far, but similar situation, sideways price action for 6 months, and then like 3 weeks of up. Crappy price action, a few weeks of up. This is what Bitcoin does. And it's been doing this, by the way, for a long time. Even if you were to go back here, if you take away, these big moves here, it doesn't just move up all the time. There's a lot of games that happen, supply demand sort of game that's being played. Right now, you have a bunch of whales who probably bought down here thinking, okay, it's towards the end of the cycle. I'm going to sell no matter what. It happens to be in August and September that people don't like to buy hand over fist risk assets generally, but especially crypto when it's on the end of the risk curve. So it's no surprise that it's going to be a little heavy. It doesn't have the ginormous piping that we call passive flows via, the 401ks and just the traditional finance pipes of liquidity that moves into those assets. It's just different than crypto. Literally a year ago, people thought crypto was going to go to zero and be basically banned by the U.S. federal government. Okay, it is going to take time for the institutional finance within the U.S. in particular to jump into these things. It does not happen overnight. They are slow when they move capital, the really large size. Okay. So it's not surprising to me that they're just, waiting to see what happens. A lot of people want to see, as we get into October, into Q4, what the prices look like. But I want to go into why, outside of the chart looking still pretty good, by the way, to sort of reiterate on the chart right now to finish up this basic technical look here, you just lost the 8-day moving average. That's it. Like this chart is still super bullish. You're above the 20-day moving average. You're above the 50-day moving average. You're above the 100. So I don't know why people are looking at this as anything but just constructive consolidation. Okay, if we were to lose this level right here, that is when you have to say, okay, all right, I got to reduce my risk because I don't know if this low holds. Clearly, prices are weaker than I expected. And you have to be more careful. But until it does that, I'm going to remain fully bullish. And I'm going to go into why from a more of a fundamental standpoint as opposed to just looking at lines on a chart, which they go a long way. I'm a huge chart person, but you have to have context for the chart, which is really best for measuring your risk reward. Okay. Let's talk a little bit about let's talk a little bit about something. So I've been writing an article that you'll see come out here pretty soon, but I kind of want to go into a couple of things that I talked about in this article. Okay, so if you see this chart here. Okay, I'm gonna zoom in. This was the big drawdown that we had. Okay, back in April. You have to start here to understand where we are right now. This completely reset positioning. Completely reset positioning. This was one of the most brutal pullbacks, believe it or not, over like the last 20 years in terms of speed, velocity. The time it took to actually do this 20% was very fast. To put it in perspective, in 2022, it took about a year, roughly, or maybe it was more like 6 months, to go down about 25% for the S&P 500. You did that in a month and a half. And a big part of that was actually like less than that, right? This piece right here. Why is that important? The velocity is really what scares people. It causes people to capitulate, get out, it freaks them out, and they definitely don't buy the bottom, right? Then you know they didn't buy the bottom. Do you remember what your timeline looked like down here? You probably don't, but it didn't look great. So I don't know if you can see this chart here. Okay, I'm not sure how well you can see this with this video. But I can tell you from the data I've been looking at, institutions didn't buy the dip. They simply did not buy it, and they did not buy on the way up at least as much as they need to perform. What do I mean to perform? Or to perform well, I should say. If you have a hedge fund, okay, you're supposed to have performance. That's what your business is for, is to make money in the markets. Well, if you didn't buy the dip and you didn't buy on the way up and the markets are screaming to the upside, well, it's not a great situation for these funds when they have to put out a quarterly performance report and explain to their investors why they didn't do well. Well, as I've said, they didn't buy the dip and they didn't even buy it the way up. And they've been hedged all of August into September waiting for this big dip to happen, right? Everyone's like, oh, we're going to get this big dip in September, which we could still get, but they've been waiting for it, which means they are not positioned for what we've already had up to the point that we're at now, which is like 66.50 for SPX, but they're surely not positioned well enough for Q4. Well, it appears to me that they have a problem in that they're going to get into Q4, probably not long enough, because remember, they're waiting for this big dip. So they're going to have to buy any pullback. And that's what you've been seeing over the last month or so, is all these dips just get bought. Not really for Bitcoin, but for SPX, okay, which is closer in on the risk curve. And we're going to go into why that matters. Retail was actually the participants who bought the dip and have been buying all the way up. So the retail is actually winning, which is really funny. And when this data initially came out, it was understood. And I remember these people were like, stupid money bought it. It's going to roll over and we're going to retest that low or make a new low. Never happened. So while positioning is starting to get more what you would expect in a super bullish market, it is not nearly as frothy as you would expect when you're just cranking new all-time highs week after week. And remember, if we were to get a pullback, you have a bunch of people who don't own enough assets right now. So it is a beach ball underwater type of situation. Does that mean that you can't get left tail or some sort of event that freaks people out? Of course you can have that. But in steady state, in the conditions we have right now, unless you get something, like, I don't know, China-US war, or like something that freaks people out. The Israel-Iran thing has been one of the sort of regular FUD events. You need something like this at this point to really get it to go to the downside. And even if that were to happen, barring like U.S.-China war or something, I don't think you're going to get much of a pullback. So this is why I'm actually pretty bullish on where we're going. And because people have been underperforming this market, not buying as nearly the amount of assets that they would need to perform well, we're talking about institutional finance, okay, I believe that they will start to go further down the risk curve, okay? So when I look at small caps, for example, this is the Russell 2000, this is like on the verge of a 4-year breakout. Why does that matter? Again, they've been underperforming. They're looking for performance. You know that Max 7 is getting, I wouldn't say it's frothy, despite what people would say, but I mean, it's hot. It's been going up. It's super over-owned for good reasons, but it's very, over-owned. Naturally, towards the end of these cycles, you start to see rotations into the small caps and to further down the risk curve. This is why IWM, Russell 2000, is starting to do well. Well, this is the same story for crypto. Notice how these charts are basically the same. This is the crypto market cap minus Bitcoin and ETH. So really altcoins, right? Altcoins as we know them. On the verge of a 4-year breakout. The same story. For most of the rally, you've had people buying Bitcoin. It is not until the end that you really start to see money going towards the end of the risk curve. Now you may say, well, Sky, I know that it's easy for market participants to buy small caps because of their, they can buy them from the comfort of their established brokerages, but altcoins don't have the piping to, for people to buy them. Well, that's why this new SEC ruling or whatever you want to call it about these ETPs or these exchange traded products, streamlining the process to list these digital assets. You remember that headline a couple of days ago? That's why that's really important, is that creates the piping so that you can have FinTwit and even institutions at some point join in on that game. And I do believe that you will see a decent amount of liquidity move into them of the likes we have not seen really this entire cycle, which has really just been the same money rotating in and out of things, which is why this has struggled to break out. You need new capital coming in, and I think that creates the piping required for that. And then you have the Clarity Act that should be passed by the end of the year, or maybe even by the end of September, last time I checked, which will actually create like sort of the road, so to speak, for it creates really the rules for how TradFi can really interact with blockchain. Okay, that, believe it or not, that doesn't exist. So when they passed the Clarity Act, when they passed the Genius Bill, which everyone was super excited about, which is great, but that was sort of like making cars legal, but you don't have any roads to drive down. So the Clarity Act is sort of like the roads to drive the car. Okay, so it's no wonder why everyone feels like the crypto legislation that has came through earlier is meaningless. Well, it's because like we're still at that point where there's no clarity on how these institutions can actually interact with the space. So once that gets passed, in conjunction with the ability to create these ETPs very quickly, I think this is going to be really good for this chart here. Okay? So you kind of get the point. Traditional finance, or I should say institutions, hedge funds, they didn't buy the dip. They didn't really buy much on the way up. Markets are not nearly as frothy as people think. Many will chase further down the risk curve to try to catch up. And that is why if you get dips, they are for buying. Okay, this is why SPX, and we'll go to SPX here. That is why it's not pulling back, guys. That is why this chart looks like this. Okay. Now, there are some risk going into the next few weeks. I do think there is a window potentially here for somewhat of a pullback, and that is because corporate buybacks, which that is, these big tech companies in particular, will not be buying back their stock going into Q3 earnings reports. Okay. and then they will start buying back in October, but that is a significant amount of liquidity that will be lost temporarily. And markets are already pretty juiced, so it's not hard to see how this could be a little shaky for the next few weeks. Not to mention, some people are doing well going into Q3 earnings, and they may rebalance going into the end of the month, taking profit, securing profit, right? So it wouldn't be surprising if we saw some heaviness going into the end of the month, which is the end of Q3. But once we get into Q4, I think there's going to be a lot of people saying, "Okay, time to go. We got it. We're going to finish this year strong." And they're going to be buying assets. I don't think you will see really much weakness until we get into November and December. But I do think by the time you get to December, you probably would have definitely reached the point where these markets are actually frothy. Okay, I'm going to keep this video short. I'll try to make more of these in the future. But until next time, have a good weekend.